Hey, Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern, every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, Wall Street has crowned Nvidia the king of AI, but every empire falls eventually. After a 1,200% surge and growth to $275 billion in revenue, the sharks are circling, and deals between OpenAI, AMD, Broadcom, and Google show an alliance forming to overthrow the king. I'm going to reveal the 5 stocks to buy in this revolution, along with important news for investors in SoFi Technologies, Chevron, and an update to our market outlook. First to that top story though, because Nvidia has dominated the AI theme, supplying those high performance chips needed, and it's been reflected in that share price, up 1,200% over the last 5 years, along with nearly a fivefold increase in revenue over just the last 2 years. But Nation, we are starting to see cracks in that chip domination. AI model Anthropic announced a deal with Google Cloud just last week to use up to 1 million of Alphabet's TPU chips to run in its AI rather than Nvidia's GPU products. OpenAI signed a deal with Broadcom in September to buy 10 billion of its custom AI chips to train versions of the ChatGPT, following a deal by AMD to deploy 6 gigawatts of AMD's Instinct GPUs, a deal that could see OpenAI buy as many as 6 million AMD chips and also tie the two companies together with a stake in the chipmaker. And against this increased competition, shares of Nvidia have gone nowhere since July, and its revenue growth is expected to slow to just 33% next year, about half of this year's 58% pace. Nation, in investing, you cannot get married to your stocks. You cannot get emotional about these companies. So even diehard investors have to ask, is this the end of Nvidia's historic stock run and that domination in the AI theme? And here the short answer, no. I'm not going to sit here and try to scare you into dumping shares of Nvidia, but this is also something that you cannot ignore. First, understand that much of the impetus behind these deals are from the giant demand for AI-powered chips that Nvidia just can't fulfill all of them. So you see Anthropic go into Alphabet's tensor processing units, those TPUs, rather than Nvidia's graphics processing units, those GPUs. Now, the TPUs are specifically designed for AI workloads, so they do the job well, even if they're not as flexible or as programmable as the GPUs. AMD's chips may not be as powerful, but they are a hell of a lot cheaper than Nvidia's Blackwell chips and perform just fine in those lower demand inference computing workloads. But the fact remains that Nvidia is going to have to run like hell to keep that AI advantage, and it's going to see more competition. Each of its hyperscaler customers, Alphabet, Microsoft, and Amazon, are developing their own chips. Amazon announced a major breakthrough with its Trainium 2 chip late last year to power a ultra-cluster supercomputer. So we start to see that $275 billion in revenue and the double-digit pace of growth starts to look vulnerable as the competition in AI chips evolves. Now again, I'm not saying King Nvidia is going to be overthrown, but it drives home the point that you have to have investments in other chip makers and throughout the AI supply chain. We're up 110% on our shares of AMD just since earlier this year, a profit of $338,000 in my personal portfolio, and while shares have come up to 9.3 times on a price to sales valuation, so much more expensive than the 6 or 7 times where we started buying at, that's still less than half as expensive as investors are paying for that share of Nvidia, 28 times price to sales. That means Nvidia investors are paying $28 per share for every dollar in sales generated by the company. That's versus less than $10 per share they have to buy for AMD revenue. And while the faster sales growth at Nvidia does justify some of this premium, AMD can still be a good value play. But then diversifying even further means following that AI supply chain to all the stocks that are going to benefit. In accelerators, so the companies making those XPUs that help you get the most out of those chips, we have Broadcom, ticker AVGO, and Marvell Technologies, MRVL, both very strong companies in this theme. And in servers, so the hardware that holds thousands of those Nvidia and AMD semiconductor chips within the data center, we have the channel favorite supermicrocomputer, ticker SMCI. Now, the company spooked investors last week, cutting its current quarter outlook to just $5 billion in sales. That news sent the shares down 8% on the day, even though management reaffirmed its full-year sales outlook, saying that the shortfall was just a delay in orders and would be made up in the next quarter. And further into that data center infrastructure, one of the biggest themes we've been following all year, the bottleneck in networking lifting those stocks Here we see Broadcom again with its advantage in scope across data center hardware and software, as well as Arista Networks, ticker ANET. Nation AI is the biggest tech revolution in 25 years and the opportunity of a lifetime for investors. But no matter how much you love one company, no matter how much money it's made early investors, you do not want to bet your financial future on just one stock. Nvidia will continue to dominate that conversation in AI stocks, but don't let it dominate your portfolio. Now I'm going to show you the stocks I'm watching this week, including an update to SoFi Technologies and our market outlook next. But investors are always asking me which investing platforms I use and are surprised when I tell them I have an account on 7 different sites. And I use some of these for research, some for easy automated investing, and all of them I got free stocks or cash back when I open the account. That's why I set up this page with money.com. Check out the link I'll leave in the description to see a full list of the sites I use, along with special offers and freebies on each. For example, you'll get up to $1,000 in stock with a new account on SoFi. Robinhood gives you a free share, and Moomoo is going to give you up to 60 free stocks on top of that 8% yield on your savings. And these are all platforms and sites that I've used and totally free to sign up and start investing. So look for that link in the description and get your free stocks. Looking at the stocks I'm watching this week, SoFi Technologies, ticker SOFI, reports earnings on Tuesday with the stock up 88% just this year and a return of 315% since I started recommending it here on the channel. The online financial services bank is expected to post strong 30% revenue growth and 8 cents per share for the quarter. Other bank earnings have been good, especially competitor Ally Financial, which beat both revenue and earnings expectations despite higher auto lending delinquencies. But I think SoFi is priced to perfection here, with little upside potential on a good report and a lot more downside risk on a disappointment. The shares are now trading at 4.5 times on a price to book value basis, which is ridiculously expensive for a bank. For reference, most bank stocks, including Ally, trade for closer to 1 or maybe 2 times their price to book value. So here SoFi is at least 2 times more expensive than that. Now you could argue that this is a growth stock and not a bank with that rate of revenue growth, but eventually the valuation has to come down to what this stock really is. I'm also watching Fiserv, ticker FI. It's going to be reporting its earnings on Wednesday, and I continue to believe that this one will be one of the best rebound stories over the next year. The banking services company is in the background of nearly every bank transaction you make, with 6 million merchants and 10,000 financial institutional clients. And growth is respectable here at about 9% expected this year and just over $10 in per share earnings. That alone makes the stock attractive at about 12 times price to earnings basis, a third of what investors have paid for it in the past. But the big upside here is the company's move into stablecoins earlier this year. Fiserv is launching a stablecoin that can be used by its 3,000 regional banks and 10,000 institutional clients to cut costs and speed up transactions, something that could unlock a lot of value in these shares. And in that AI theme, AI energy stocks present another way to protect your money from a popping of the AI bubble. Now, I laid out 3 scenarios 2 weeks ago, including a put strategy on shares of Taiwan Semiconductor that can make you money if that AI stocks tumble. Now, I'm still heavily invested in the AI theme with stocks like SMCI, AMD, SoundHound, and Symbotic, and think that bubble inflates for at least another year. But you also can't ignore the amazing run we've had this year, more than 100% returns in several stocks. So I'm looking for cheap ways here to protect my downside from that sudden crash. This article from the Wall Street Journal last week points out that while big tech is expensive, free cash flow is still extremely strong and balance sheets look healthy. The same cannot be said for some of the newer energy names surging in the theme. Shares of nuclear startup Oklo, ticker OKLO, are up over 700% this year and valued at $26 billion, despite the fact that it isn't expected to book revenue until 2028 and profits years later. Shares of Fermi, ticker FRMI, just went public this month at a $19 billion valuation without lining up any binding customer contracts and only securing enough equipment to meet 5% of its power generation goals. So much like that put strategy on TSM, we can buy deep out of the money puts on these as an insurance contract against that AI bubble. For example, if that bubble bursts, shares of Oklo could dive way down below $50 each where it traded at in June. Buying a January 27 put option on the $50 strike price gives us a year's protection for less than $8 a share. Now, a crash in the stock could make 5 or 8 times the money on that, helping to offset the pain in some of your other AI stocks. Now, again, though, this is like an insurance contract, so you only want maybe 3 or 4% of your money in these at most, enough just to offset heavy losses, but not enough to detract from the returns if that AI bubble keeps inflating. Showing you that bigger picture here with the Sector Spider's sector tracker. 9 of the 11 stock sectors closed higher last week, with energy stocks rebounding on a 7% jump in the price of crude oil. The lone laggards here were utilities and consumer staples, as would be expected when investors exit those safety sectors for returns in a risk on market. President Trump's trip to the APEC summit later this week should dial down those trade war fears, at least for the moment, and help stocks continue this upward climb. For the year, just 3 sectors are posting returns of less than 5%, including real estate at 4.8%, energy 2.8%, and consumer staples just 0.61% return for the year. Now, consumer staples companies are in value territory, but are still going to struggle with a weakening consumer and tariff costs eroding their profit margins. Energy stocks saw a rebound last week, but a sluggish economy probably means investors are going to have to wait a little bit longer there as well. It's a relatively safe sector and strong cash flows, but investors are going to need more patience on that. Of the 3, though, real estate stocks are best positioned for a near-term rebound as those lower borrowing rates and slow recovery in office property helps lift prices. Updating our market outlook, the government shutdown is now the second longest in history at 27 days, a week under that 35-day shutdown in 2018, but doesn't appear to be causing much economic pain just yet. That could be a problem as both sides feel little need to negotiate. Fortunately, though, corporate earnings have been extremely good, with companies in the S&P 500 reporting profits up 9.2% from last year. Now, while stocks are expensive, trading at a price of 22.7 times expected earnings, that is 22% more expensive than the 18.6 times average that they've traded at over the last decade. There are reasons to believe that that bull market can keep charging. First of all, profitability, shown here in net margins for each sector, well above that longer-term averages in all but 4 of these groups. For example, profitability at tech companies is 26.8% in the third quarter, well above that 24% average margin the group has reported over the last 5 years. So, even as the economy does show cracks of weakening, we see profitability and corporate earnings holding up very well, supporting those stocks. And now part of this is from that revolution in artificial intelligence, but a bigger reason is just the cost cutting and the jobless expansion. Across the market, companies are announcing layoffs even as profits rise, contributing to that higher productivity and the profitability. Now, it's not great for workers and could start to weigh on consumer spending, but for now, it's pushing those stocks to record highs. And the Fed is another area of support for stocks, with the central bank expected to cut rates again when it meets on Wednesday. The CME Fed Watch tool shows the market putting a 96% probability that the Fed will cut rates by another 0.25%. Now, it's not the super cut that the president wants, but will lower borrowing costs for businesses, and expectations for 1 more cut this year, along with 3 cuts next year, should continue to support stocks. So nation, as you hear pundits scream that stocks are too expensive or in a bubble, remember, markets don't fall just because they get expensive. There always needs to be a catalyst, and apart from that potential for the US-China trade talks to include a change to that Taiwan policy, there are no real catalysts on the horizon. That means while I would hedge that off chance of a Taiwan threat, investors can continue to invest without worrying. Get free stocks and cash back on some of the investing sites I use. Check out the link in the description for special offers and freebies. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.